Alright you guys, the date is April 13th, and today I'm going to show you how I look at the pre-market and how that's used to sort of predict what the implied move, the implied volatility, and what is more probable to happen tomorrow. And so these are the things that I go through in order to decide what I believe is the most probable thing that's going to happen in the market. So first off, we're going to take a macro scale picture here up at 10,000 feet, and we're going to look at the S&P 500 index. And again, we're going to zoom in here. This is on a weekly chart, and you can see this trend channel that we've been following since early 2018. Okay, and you can see that we have priced in a trend channel here of support in blue, and the top of that is a trend channel of resistance, also in blue. And we have basically followed this for 7 years, give or take. Okay, now we can see some white lines here, which are various forms of support and resistance. To add to that, we have the COVID high, which coincides with the 2022 low, so that is a huge point of support. We also have the high of 22 before that market cycle, which coincides with the 200-day moving average right here below our support. So we have multiple layers, 3 layers of support right here. And then if we zoom in on a closer scale, now we're looking just in the last year right here. You can see that we've bounced off this point 1 or 2 times, and this is our 3rd time here, and we bounced off of this with a lot of strength. And now what we're looking at here is actually a point of resistance for us unless we break through that channel. So let's take a little deeper dive and take a look at this. We're going to look at the VIX, we're going to look at the futures, we're going to look at the 30-year treasury yield, we're going to look at the options market and what pre-market is doing. So we can see the past few days have been very volatile, obviously, and so we sort of predicted that we would bounce out of this move, and now we are sitting dead center of a fair value gap move. Okay, so this is one gap and another smaller gap, and now we're trying to decide, are we going to go in this direction or are we going to reverse? Okay, and so how we would sort of look at this is a couple of different ways. Number one, I'm going to just take a look at the VIX. Okay, that's the volatility index, and what we'll take from the VIX is that on a multi-day scale, so this is about a week's worth, we're noticing a trend in the downward direction. Okay, so that's always good. That means typically you won't have as much movement up or down with the stock price if the VIX is going lower. Okay, the VIX is still high. Anything really above 15 is considered a pretty volatile market, but we are down from a high of 60. Okay. Another thing that I want to look at is the 30-year treasury yield. And what we'll notice with the treasury yield is things are still moving and grooving to the upside with the treasury yield. Let me just restart that screen. Sorry. So we've got the treasury yield here. And if we take a look on the broad scale, again, that treasury yield is still remaining high, which means if the treasury yield is high, that's because the prices are quote unquote low because you don't have a ton of money flooding the bond market. Okay. Now, let's also take a look, and this is probably the most important thing, which is the S&P 500 E-mini. This is the futures contracts. Okay, so this is going to look quite a lot like our S&P 500 index. The only difference is this index of futures is open pretty much 24/7 except for Saturdays. And so trading will actually happen on Sundays and any other day of the week other than Saturdays. And what I've highlighted here in white is actually where the stock market stopped trading on Friday. Okay, and this is including after hours trading. So when I look at the stock market, the S&P 500 index, where we stopped trading right here, this was the last trade Friday, April 11th at 4 p.m. Central Time. So that's after hours trading in this little blue box. If we go here, that is exactly where we stopped in the S&P 500 index after hours trading. And then this whole move right here, this is the futures contracts trading. And what we notice about this is if I can make, let's do a price range forecast, and we'll go from the lows at after hours trading. I'll see everything is not loading correctly. Let's try that again. Okay. Delete that box. Let's try this again. And if we do a price range chart, this doesn't even look right. What happened? Delete that. There we go. We'll do a price range chart here from where we closed to where we're currently at. Okay, so after hours, or in the futures contracts, we're looking to be about 51 basis points up, or about a % move in the up direction. Okay, so the futures contracts is showing me a move to the upside, which I can't see on the S&P 500 because it doesn't trade in that time period. However, the S&P 500 E-mini futures, they trade off of the underlying asset, which is the S&P 500. So I might be losing some of you guys here, but just keep in mind that you're basically able to see the future. And this is exactly what CNBC Finance and all those other applications use for pre-market data. This is where pre-market data is coming from. It's coming from the minis, the S&P 500 mini, the futures contracts, commodities contracts, etc. And you can see here that CNBC Finance is reporting an uptick of about 54 basis points. And I showed you an uptick of about 51.5 basis points. So we're in the ballpark, okay? So that's a move to the upside. So we can say that if we look at just the S&P 500, there's been a small uptick. That's not working again. That's lovely, but it's a small uptick to the upside. Now, let's say that we didn't have that data and we wanted to look it up on the options chain. Well, we can do that as well. We can take a look for tomorrow, which is the 14th, near the money, and I'm going to do a side-by-side graph, and I'm looking at the S&P 500 SPY index options trades. Okay, so this is the bid-ask spread for both the calls and the puts at the current trading price of looks like it's trading at 533.94 was the last open trade. Yeah. So if we go back over here and we look at let's go with 534, and our ask for the call side is $700, and our ask for the put side is $648. So there is a premium of about $52 in the call side direction, which means that the market makers have adjusted the prices to make it more expensive to buy the call option, which means they assume that the market will go up. Now we can take a look and see what their implied volatility would be for this move tomorrow by taking the ask of the call, the ask of the put, adding those together and multiplying by a derivative of 85%, and then we will then divide by the underlying strike price. So we can do that right here. So we'll do 700 plus 648. That's 1348. We're going to times that by the median, and then we will then divide that by $534, and that's going to give us an implied move of 2.14%. So that's still a pretty big move, but we need to subtract the fact that we have about a 1% move, give or take. We have about a 1% move in the market, so we can assume about a 1.1% implied move in tomorrow's trade. And so what would that look like? Well, we can take a look, and I'm not sure if this will work or not because it's kind of freezing. but it looks like a 1% move in either direction would sort of keep us within this window or box. And then that full implied move of 2.2 or 2.3, 2.1, I think, would bring us right to the top of that fair value gap. So what the market has priced in for tomorrow is a move from here. The cursor's not working, but basically a move from here into this fair value gap region, give or take. So that's based on the options makers, the premiums that they've applied to this. That's also based on removing the or utilizing the pre-market data, which I've verified using the VIX index, or not the VIX index, but the S&P minis. And then I also verify that by looking at a downtrend in the implied volatility by utilizing the VIX. And then just by looking at it and looking at technical indicators, which shows that we would likely stay within this realm tomorrow and try to break out one section or another. And if it was going to try and break out of here, that would be about a 2% implied move. So that is typically how I will take a look from this large macro scale down to the very small micro scale of the one-day plays. And then based on that, if you want a dollar cost average in, or if you want to utilize options contracts for this, then you could. I hope you enjoyed this video. We'll see what happens tomorrow, and we'll see if that implied move that I've predicted here based on the indicators is correct. All right, thanks guys. Like, share, and subscribe, and we'll see you on the next video.